Hello everyone, and welcome back. If you've been following the crypto world, you know that things can change in the blink of an eye. But even by crypto's wild standards, what happened this weekend was truly extraordinary. Over the weekend, the crypto market experienced a massive crash. Prices for Bitcoin, Ethereum, and nearly every other coin dropped sharply and suddenly. It was a dramatic, almost surreal moment for anyone watching the markets. For many investors, it felt like a roller coaster plunging without warning. One minute, portfolios were looking strong. The next, values were evaporating before their eyes. Billions of dollars vanished in hours, shaking even seasoned traders. The speed and scale of the losses left people stunned, and social media was flooded with reactions and theories. So, what is a crypto crash? It's when digital currency prices fall dramatically because a huge number of people start selling at once, overwhelming buyers. This sudden imbalance causes prices to spiral downward, often triggering panic selling. These events test the market's strength and remind us how volatile and risky crypto can be. Even the most experienced investors can be caught off guard by the speed of these moves. This crash was historic, fast, brutal, and unexpected. It will be remembered as one of the most significant moments in recent crypto history. Understanding why it happened is key to becoming a smarter investor. By learning from these events, we can better prepare for the future and avoid common mistakes. In this video, we'll break down the numbers, look at the biggest losses, and see which coins were hit the hardest. We'll explore the main theories behind the crash, from technical triggers to rumors and news that may have fueled the panic, and we'll explain how it all unfolded, step by step, so you can see how quickly things can change in this market. We'll also look at what an oracle attack is, and why it's become such a hot topic in the crypto community lately. We'll show how different coins were affected, from the biggest names to smaller altcoins that saw even steeper drops. And we'll see how big investors, like hedge funds and institutions, reacted. Did they panic, or did they see opportunity? Finally, we'll discuss what to watch for next, including key indicators and warning signs that could help you stay ahead of the next big move. And we'll talk about what this all means for the future of Bitcoin, Ethereum, and the entire crypto market. Let's dive in and make sense of it all together. Grab your coffee. This is going to be eye-opening, and you won't want to miss a moment. To grasp the scale of the crash, let's look at the numbers. Over $19 billion in leveraged positions were wiped out, 9 times bigger than the February 2025 crash. The global crypto market cap dropped from $4.24 trillion to $3.76 trillion, nearly $500 billion gone in a day. Trading volumes spiked to $234 billion as panic selling took over. Out of the top 100 cryptocurrencies, 97 saw significant losses, a sea of red everywhere. Liquidations drove the rapid decline. When leverage bets go wrong, exchanges force sell assets, triggering a cascade of more liquidations. This chain reaction accelerated the crash, exposing how much risk had built up in the system. The market's optimism vanished, forcing a painful but necessary reset. Excessive speculation was cleared out in brutal fashion. Why did the market crash so hard and so fast? In the aftermath, 2 main theories quickly emerged, each with its own set of compelling evidence and passionate supporters. The first theory points to global fears. US-China tensions escalated with the announcement of new tariffs, and renewed worries about the stability of US banks resurfaced, spooking investors everywhere. Headlines blared warnings, and the mood on Wall Street turned anxious, as uncertainty rippled through the financial world. When fear takes hold, risky assets like crypto are almost always the first to be sold off. Investors rush to safety, triggering a wave of panic selling that can quickly spiral out of control. But there's a second, more intriguing theory. One that suggests the crash wasn't just a reaction to headlines, but the result of a deliberate, sophisticated oracle attack. On-chain data reveals that a powerful entity may have exploited a known vulnerability, triggering a massive liquidation cascade for profit. This wasn't just market panic, it was a calculated move, executed with precision. So, what's the most likely scenario? In reality, both factors probably played a role. Macroeconomic fears set the stage, and a targeted on-chain attack lit the fuse, amplifying the chaos. The result was a perfect storm, a collision of old-world financial panic and new-world digital manipulation, creating a market event unlike anything we've seen before. This crash is a stark reminder of how traditional risks and crypto-specific vulnerabilities can combine, leading to unprecedented volatility and uncertainty for everyone involved. Understanding both sides, the global economic backdrop and the technical on-chain details, is absolutely crucial for anyone hoping to navigate future market shocks and protect their investments. Now let's break down the attack itself and see exactly how it unfolded on-chain. The most alarming part of this crash was the Oracle attack. Oracles feed real-world data, like prices, to DeFi platforms. If they're compromised, chaos follows. Binance was updating its Oracle system, creating a brief vulnerability. A whale, suspected to be Garrett Jin, built a $1.1 billion short position and exploited this window. At 5:43 a.m., the attacker dumped $60 million of USDE, causing it to depeg and triggering false price data. DeFi protocols, trusting the manipulated prices, liquidated user positions, starting a chain reaction. This forced selling spread to Bitcoin and Ethereum, igniting a $19.3 billion liquidation cascade, all from a $60 million move, showing how fragile DeFi's price feeds can be. The attack exposed a critical flaw in decentralized finance. The industry must address these vulnerabilities to prevent future disasters. Bitcoin and Ethereum were at the center of the storm. Bitcoin dropped from $122,574 to $103,600 in hours, erasing weeks of gains. It's now hovering around $105,700, down 13% for the week. Key support is at $99,900. If it breaks, more selling could follow. Resistance sits at $122,000, $126,000. Ethereum fell even harder, from $4,055 to $3,136, now at $3,764, a 17% weekly loss. Many DeFi protocols attacked were built on Ethereum, shaking confidence further. ETH's main support is $30,400, $30,600. If it fails, the next stop is much lower. Resistance is $4,200, $4,500. The battle at these levels will decide if recovery is possible or if more pain is ahead. Both coins' technicals are under the microscope. The next moves will set the tone for the entire market. Traders are watching closely. The stakes couldn't be higher. Altcoins suffered even more than Bitcoin and Ethereum. When panic hits, smaller coins get hit hardest. Many lost over half their value in a day. Hype crashed 54%, Doge dropped 62%, and Avalanche plunged 70%. Even major tokens like BNB and Solana weren't spared, losing billions in value. Investors fled risky altcoins for the relative safety of Bitcoin. On-chain data showed capital rotating into BTC, not leaving crypto entirely. The crash was a harsh lesson in risk management and diversification. Overexposed investors saw their portfolios decimated. Recovery for many altcoins will be slow and uncertain. The crash triggered widespread panic. The Crypto Fear and Greed Index plunged to 28. Deep fear territory. US-listed Bitcoin and Ethereum ETFs saw $593 million in outflows in a single day. Even big players were nervous, selling off and adding to the pressure. In the options market, traders rushed to buy puts, betting on further declines. Popular strike prices for puts signaled expectations of more downside. This combination of fear, ETF outflows and hedging painted a clear picture. Investors were de-risking fast. For contrarians, extreme fear can be a buying signal. The big question, is this the bottom, or is there more pain ahead? Only time will tell. What's next for crypto? All eyes are on Bitcoin's $99,900, $100,000 support. Holding it could signal a recovery, but a break could mean more losses. Macroeconomic headlines, US-China tensions, banking fears, remain crucial. If the news improves, crypto could rebound. More bad news could trigger another drop. Watch ETF flows. A reversal from outflows to inflows would be bullish. Options activity is another key signal. More calls than puts would show rising optimism. The whale behind the attack still holds a massive short. If they close it, it could spark a rally. On-chain data will reveal their next move. The market is on a knife's edge, with buyers and sellers battling for control. Stay alert. Volatility isn't over. Every crash teaches hard lessons. For many, the pain is immediate: losses, confusion, and a sense of uncertainty about the future. But these moments also force the entire crypto community to reflect, adapt, and innovate. This event exposed a major DeFi flaw: Oracle vulnerability. Oracles, which feed real-world data into blockchains, became a single point of failure, making the system fragile and open to exploitation. The Oracle attack theorem is now proven. Small manipulations can trigger massive liquidations. Even minor price distortions can ripple through the system, causing widespread chaos and loss. Developers must build more robust, decentralized oracles to prevent repeats. This means not just patching vulnerabilities, but rethinking how data is sourced, verified, and distributed across networks. On the bright side, the crash cleared out excessive leverage, setting the stage for healthier growth. The market, though shaken, is now more stable and less prone to reckless speculation. Like a forest fire, it burned away the dead wood, allowing new growth. The ecosystem is now primed for innovation, with stronger roots and a renewed sense of purpose. Despite chaos, long-term adoption continues. Florida's House Bill 183 could let state funds invest in Bitcoin. Regulatory interest is growing, signaling mainstream acceptance is on the horizon. Institutional interest remains strong, even as prices fall. Major players are using this time to strategize, accumulate, and prepare for the next wave of growth. The crash was a perfect storm of fear, uncertainty, and technical exploits. It tested the resilience of everyone involved, from individual investors to the largest institutions. But the core technology and long-term thesis for Bitcoin and Ethereum remain intact. The vision of decentralized finance and digital assets is stronger than any single setback. Key lessons: manage risk, avoid excessive leverage, and keep a long-term view. Education and discipline are more important than ever for anyone in this space. The path forward will be tough, but the ecosystem will emerge stronger. With each challenge, the crypto world becomes more resilient, more innovative, and more prepared for the future. Thanks for watching. Stay smart, stay safe, and remember, every setback is a setup for a comeback.